Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Navitas.
If you find our talks useful, please consider subscribe, like, and comment underneath. So today we're looking at a company that is, well, it's burning more than double what it actually brings in.
Yeah, the numbers are rough.
Right. Operating at like negative 234% margins, and yet its stock just violently exploded 20% in a single day.
Just massive movement.
Yeah. Anyone who's been watching the market here in late April 2020 stocks has seen this chart absolutely gapping up, entering heavily overbought territory. And so the question is, are investors just completely losing their minds, or are we looking at maybe the ground floor of a massive AI infrastructure supercycle?
I mean, look, when you see a chart go parabolic like that, it automatically triggers skepticism. And rightly so, right? It looks like meme stock mania on the surface. But if we peel back that daily trading noise, there is actually a really fundamental structural corporate transformation happening here. So the objective today is to map out the underlying mechanics of what they're actually building. We want to help you figure out if this repricing is just, a temporary short squeeze contagion, or if it's a multi-year wealth building opportunity that's just kind of hiding in plain sight.
Yeah, and to figure out if that unyielding momentum is actually justified, we have to start by looking at what management deliberately dismantled.
Exactly.
They're calling this era Navitas 2.0. And I think the best way to visualize this pivot is, well, imagine a wildly successful fast food restaurant.
Oh, I like this analogy.
Right. So they have lines around the block for these cheap $2 burgers. They're moving massive volume. But one morning, management just locks the doors, throws all the grills into the dumpster, and announces, we are a Michelin star steakhouse now.
Yeah, they literally threw out the grills. And with them, a massive chunk of their reliable historical revenue.
Right.
If you just glance at their immediate financial results without understanding that overarching master plan, the numbers look utterly catastrophic.
I mean, catastrophic almost feels like an understatement here. Let's just lay out the ugly metrics for you so you know exactly what you're looking at.
Lay it on me.
Okay, so fourth quarter of 2025, their top-line revenue was a mere $7.3 million. Total trailing 12-month revenue shrank down to $45.9 million.
Ouch.
Yeah, and those operating margins we mentioned earlier, sitting at an abysmal negative 234.7%. Their R&D intensity, so like the amount they're spending on research and development relative to their sales is at 108.5%.
It's wild.
They're essentially burning the furniture just to keep the house warm at this point.
They are, yeah. The cash burn is intense, but the nuance here is really in the composition of that remaining revenue. Historically, their bread and butter was commoditized mobile phone chargers.
Oh, like the little power bricks you plug into the wall?
Those exact bricks. That was a high volume but incredibly low margin business, so the fast food burgers of your analogy. They made a calculated decision to shed that business entirely. Because of that deliberate unwinding, mobile revenue has now collapsed to under 25% of their total sales.
Okay, so they're bleeding cash today because they voluntarily strangled their legacy cash cow.
Yeah.
I mean, if you're going to pivot to a high-end steakhouse, you'd better be serving the best steak in town.
You really do.
What exactly are they replacing those, mobile chargers with?
So they're reallocating all of those resources to attack high-power, high-margin markets. Specifically, AI data centers, electric vehicles, and renewable energy grids.
Okay.
And the data shows the pivot is actually taking root. In the fourth quarter of 2025, for the very first time in the company's history, those high-power markets crossed the threshold to represent over 50% of their total revenue.
Wow, okay. But declaring you want to sell into AI data centers and actually winning those contracts, those are two very different things.
Oh, absolutely.
Because they're going up against massive, entrenched semiconductor legacy giants.
Yeah.
So what is their technological defense? I mean, why won't they just get crushed?
Well, their defense relies on a highly specialized technology mode. First, they possess a full-stack portfolio of both gallium nitride and silicon carbide technology.
Okay, and why does that matter?
Most legacy semiconductor companies specialize in one material or the other. Offering both gives them the flexibility to optimize an entire data center's power system across different voltage tiers. But the real crown jewel-like, the really disruptive element, is this proprietary architecture called monolithic integration.
Ah, right. Semiconductor engineers love their complex naming conventions. Monolithic integration.
Excellent.
Let's translate that in plain English for a second.
Sure enough. To understand why it's revolutionary, you kind of have to look at how a traditional power chip is built. Usually you have two separate components.
Okay.
You have the transistor, which is the muscle that actually handles the heavy electrical current. And then you have a silicon driver, which is basically the brain that tells the transistor exactly when to open and close.
Right.
Because they are two distinct physical pieces of silicon, you have to wire them together.
Which introduces physical distance. And, in the world of semiconductors, physical distance is the ultimate enemy.
Precisely. Those tiny connecting wires introduce something called parasitic inductance.
Sounds bad.
It is. It causes a slight delay in the signal, and more importantly, it generates heat and wastes energy.
Gotcha.
So monolithic integration means they've figured out how to physically build both the brain and the muscle into a single continuous piece of crystal. They essentially put the manager directly on the factory floor.
So by removing the wires, you just remove the lag and the heat loss entirely.
Exactly. You shrink the system significantly in physical size, you operate with vastly less energy waste, and you eliminate the most common points of mechanical failure.
That's huge.
Yeah, when you are constructing a multi-billion-dollar AI data center, physical real estate and thermal management are the two most expensive bottlenecks you face. Finding a component that requires less cooling and takes up less space, that's the holy grail.
Which perfectly bridges us into the macro environment, I think. Because that all-in-one chip architecture feels, well, custom-built for the absolute chaos happening in AI infrastructure right now.
It really does.
I mean, we recently saw them at the NVIDIA GTC 2026 showcase, and they were displaying this specific 800-volt to 6-volt power delivery technology. And NVIDIA has been extremely aggressive about shifting the entire industry toward 800-volt architectures.
Yeah, that architectural shift is the foundational thesis for this entire company. Let's look at the physics of why this transition is non-negotiable.
Okay.
Legacy cloud data centers, the ones hosting websites and basic software, they operate on 48-volt power systems.
Yeah.
But the new generation of AI processors consume power at a terrifying rate.
Right.
If you tried to push the necessary electrical current for an AI server rack through a standard 48-volt system, the sheer friction of the electrons would literally melt the standard wiring.
Wow. So it just comes down to basic electrical principles, really. To deliver a massive amount of total power without, increasing the physical thickness of your copper cables to the size of tree trunks, you just have to increase the voltage.
You have to. You increase the voltage to 800 volts, which acts like a massive superhighway. It allows vast amounts of energy to travel smoothly into the facility without generating excessive heat.
Okay.
But you cannot simply plug a delicate AI processor into a roaring 800-volt power line. It would instantly vaporize.
Right. So you need a system of dams and locks, essentially, to step that roaring river of electricity down to a gentle stream.
Perfect analogy. You step down from 800 volts to 400 volts to 48 volts, all the way down to the 6 volts that the actual processor requires.
You got it.
And every single time you step that voltage down, you require advanced power silicon. Because they hold that dual portfolio of gallium nitride and silicon carbide, they are providing the specialized chips for every single stage of that step-down process.
So the transition from a 48-volt world to an 800-volt world isn't just an incremental upgrade for them. It is an exponential expansion of their total addressable market within the exact same physical footprint.
Exactly.
So what does that actually look like for their bottom line?
The content value absolutely skyrockets. In a legacy 48-volt data center, they might capture roughly $10 to $20 million in revenue per gigawatt of power installed.
Okay.
But in these new 800-volt AI architectures, their revenue potential jumps to $30 to $50 million per gigawatt.
Wow.
Yeah, they are more than doubling their revenue per customer just by riding NVIDIA's coattails into this new voltage standard.
That is a staggering multiplier. But even with a great product and a growing market, execution's never guaranteed, right?
Mm-hmm.
Especially if the competitive landscape is saturated. Yet they seem to have caught an incredibly lucky break recently.
Oh, an unprecedented structural advantage just fell right into their lap. Back in 2025, Wolfspeed, which was widely considered the primary heavyweight rival in the silicon carbide sector, they filed for Chapter 11 bankruptcy.
I mean, the timing of that is almost hard to believe. Right at the exact moment the biggest high-power technology boom in modern history is kicking off, your main competitor just collapses under its own weight.
It ripped a massive hole in the global supply chain. In the semiconductor industry, qualifying a new chip for an automotive or data center application takes years of rigorous testing.
Right, they don't just swap parts overnight.
Exactly. Customers demand dual sourcing. They want multiple reliable suppliers. With Wolfspeed abruptly out of the picture, billions of dollars in future contracts were suddenly left without a home.
So Navitas steps in.
Yeah, the company is aggressively swooping into that vacuum. They're securing long-term, high-margin design wins that might have otherwise taken years to pry away from a competitor.
Okay, so the fundamental narrative is undeniably compelling. The transition to high-margin products is working. The technology solves a critical physical bottleneck for AI, and the competitive landscape just, well, cleared out.
Yeah.
But we really need to take a step back and address the massive elephant in the room.
Let's do it.
If the grand payoff for all of this is a mid to late 2026 revenue ramp, why is the stock violently repricing today in April 2026? I mean, a fundamental long-term thesis does not cause a stock to gap up 20% in a single Tuesday trading session.
No, it doesn't. Separating the long-term fundamentals from the short-term market mechanics is vital here. The violent price action you're seeing today is the result of corporate governance triggers colliding with aggressive forced market buying.
Okay, break that down.
On the governance side, the board of directors recently brought on Gregory M. Fisher. He's a highly respected semiconductor industry veteran.
So that signals to the institutional money that the adults have officially entered the room.
Exactly.
He gives Wall Street confidence that this incredibly complex pivot from mobile chargers to AI data centers will actually be managed competently.
Right. That board appointment sparked a wave of analyst optimism. But that positive sentiment was just the match. The powder keg was the short interest.
Oh, here we go.
Yeah. Historically, short interest on this stock has hovered around 25% of the total available float. That means a quarter of all tradable shares were actively being bet against by bearish investors.
Which, to be fair, makes sense if you only look at the surface metrics.
Totally.
The bears saw the dropping top-line revenue, the negative 234% margins, and probably just assumed the company was going to zero. But they got completely blindsided by a macro market event.
They really did. The stock got swept up in a massive short squeeze contagion that originated with Avis budget. When algorithmic funds are forced to de-risk and cover short positions in one heavily shorted stock, it often triggers forced covering across entire baskets of highly shorted equities.
Right. And buying a stock in the middle of a short squeeze contagion is essentially playing a high-stakes game of musical chairs where the music has already stopped.
That's a great way to put it.
You aren't investing based on value. You are just betting you can grab a seat before the forced buyers finish covering their desperate positions. And, well, the artificial demand evaporates.
The feedback loop is vicious. The positive news hits, the stock rises, short sellers are forced to buy shares at market price to close their losing bets.
Right.
And then that forced buying drives the price even higher, trapping the next layer of short sellers, who are then forced to buy. It creates the massive, unnatural price gaps we see on the chart today.
And this brings us to the execution risk, which I really want to challenge right now.
Sure.
Because the market mechanics have pushed this valuation into terrifying territory. Let's look at the current multiples. The stock is trading at 39 times enterprise value to revenue, not earnings, revenue.
Yeah.
And 44 times price to sales. You are paying $44 for every single dollar of sales they currently generate.
Those multiples are priced for absolute flawless perfection. There is zero margin for error built into the current stock price.
Exactly. There are headlines from major financial outlets warning that the stock is one misstep away from a sharp re-rating. I mean, if they delay a single shipment or if a data center client pushes back an order by one quarter, the bottom could completely fall out.
It could.
Furthermore, we just saw an executive insider sell off 98,000 shares in March 2026. And despite this massive 20% run-up, Wall Street analyst consensus is technically still sitting at a hold.
Right.
So if you buy in at 44 times sales, aren't you just walking blindfolded into a momentum trap?
The execution risk you were highlighting is the single most important factor for an investor to weigh. If this company had significant debt maturing in the next 12 months, or if they needed to tap the equity markets to fund their daily operations, a valuation like this would be a ticking time bomb.
Absolutely.
One missed earnings call, the stock tanks, their cost of capital skyrockets, and the pivot fails. But, and this is a huge but, their balance sheet entirely neutralizes the threat of bankruptcy.
Okay, let's examine that safety net. What does the capital structure look like right now?
They are operating with a fortress balance sheet. They currently hold $236.9 million in pure cash against a minuscule $6.5 million in total debt.
Wow. Okay.
Yeah, the debt-to-equity ratio is virtually non-existent.
But cash is only a safety net if it lasts, right? With operating margins at negative 234%, how fast is that furnace burning through the $236 million?
So their current quarterly cash burn rate is meticulously controlled at roughly $10 to $11 million. If you divide their cash reserves by that quarterly burn, it gives them a massive, unencumbered 5-year runway.
5 years.
5 years. They do not need to issue dilutive secondary shares. They do not need to take on high-interest venture debt. They are completely insulated from the capital markets while they wait for the AI data center revenue to scale up.
Okay, a 5-year runway for a semiconductor startup undergoing a massive hardware pivot is, well, almost unheard of.
It's extremely rare.
That certainly takes the risk of imminent bankruptcy off the table. But runway does not automatically equal growth. Just because they won't go out of business doesn't justify paying 44 times sales.
Fair point.
They still have to prove they can capture the market.
Yeah.
What are the concrete milestones over the next few months that will prove this execution is actually happening?
The most immediate catalyst is their Q1 2026 earnings report. That's scheduled for May 5th, 2026. The market is going to aggressively scrutinize one specific metric, and that's the high-power revenue ramp.
Okay.
Investors need to see that the 50% revenue share from AI and EVs is growing sequentially quarter over quarter. Management has guided for an EBITDA break-even target by mid-2026.
Right.
The May earnings call will reveal if they are actually on track to hit that profitability inflection point.
Got it. We also need to factor in the macroeconomic tailwinds, specifically the U.S. CTS Act, because they have a major domestic manufacturing partnership with global foundries.
That partnership is incredibly strategic. As the U.S. government injects massive subsidies into domestic semiconductor manufacturing, to counter geopolitical supply chain risks,
Right.
global foundries benefits directly.
Right. The money flows down.
Exactly. Those subsidies structurally lower the cost of goods sold, which will quietly pad the profit margins for fabless partners relying on those U.S. facilities.
Now, there's one final piece to this puzzle that we really need to address. It is unconfirmed and it's speculative, but it is a persistent drumbeat in the market rumors right now.
I know exactly what you're going to say.
They are a pure-play leader in next-generation power silicon. They have highly defensible intellectual property with their monolithic integration, and they are operating in an environment where massive, diversified legacy semiconductor firms are suddenly realizing they are dangerously behind the curve on AI power delivery.
It creates the absolute perfect recipe for an acquisition.
Right.
When a $100 billion legacy giant realizes they missed the boat on gallium nitride and silicon carbide development, they have two choices. They can spend 5 years and billions of dollars in R&D trying to catch up, or
They can simply write a check.
exactly, write a check, acquire a pure-play innovator, and instantly leapfrog the competition.
And with Wolfspeed out of the picture, the list of viable acquisition targets in this specific niche has just shrunk dramatically. It places a floor under the stock price, really, because institutional investors know that if the valuation drops too low, a larger player will immediately swoop in and buy the entire company just for its patent portfolio.
That's spot on. Synthesizing all of these moving parts, so the brutal short-term valuation metrics against the massive fundamental market shift, we arrive at a 7 out of 10 bullish investment thesis.
Okay, 7 out of 10.
Yeah, but it comes with a strict caveat regarding timeline and risk tolerance.
Walk us through the strategy. Who is this actually for?
If you are trying to day trade the short squeeze contagion, you are playing with fire.
Oh, yeah.
The volatility will be stomach-churning. However, for investors willing to look past the immediate noise, this offers incredible asymmetric upside. They are positioning themselves as the premier pure play on the 800-volt AI data center revolution. This is best suited for a 12 to 24-month hold.
Okay, so give it time.
Exactly. You have to give the massive infrastructure supercycle time to do the heavy lifting, allowing the company to hit that mid-2026 margin inflection point.
A 12 to 24-month hold to let the AI build-out materialize.
Right.
I love it. I want to leave you with one final, slightly broader thought to ponder today.
Okay.
We just spent a lot of time dissecting how the world's most advanced technology companies are being forced to completely rip out and re-architect their data center power systems to 800 volts, simply to handle the sheer force of AI computation.
Right.
And this monolithic integration is emerging as the gold standard to make that leap possible.
Sure.
But what happens when the rest of the physical world realizes it has the exact same problem?
Oh, that's a great point.
Right. What happens when nationwide EV charging networks, renewable energy grids, and just everyday urban infrastructure suddenly realize they also need to make that exact same high voltage leap to keep up with modern energy demands.
It's inevitable.
Could this seemingly isolated AI power play we're analyzing today actually be laying the foundational technology required to rewire the entire future of the global electrical grid?
It is a massive question, and, well, it illustrates exactly why looking past a 20% daily pop to understand the underlying physics of the technology is so critical.
Something to keep in mind as you watch the charts and the headlines today. We'll see you next time.